one of the things that we spend a lot of time with is working at the difference between insurance inside super and insurance outside super. And there's quite a lot to unpack there. So most Australians, unless you've positively opted out or were under 25 in the last few years, you are likely to have some form of default insurance cover in your super. That can often be very inexpensive, that default level. It's often not enough, but it's a good start, and it can often be cheap. The stuff that comes with your super fund is a type of insurance called group insurance, where the super fund contracts with the insurance company to include everyone in the group. And that's got a couple of impacts to the insurer. So first of all, it's cheaper for them to sell 1,000 or 10,000 or 100,000 covers in a chunk rather than one at a time to individuals. So the distribution cost goes down, and some of that should get passed on to the super fund by way of lower prices. The second thing that it means is that those lives aren't individually assessed, and by having everyone opt in, or having everyone in the big population participate, you get the healthy with the unhealthy. So you get a better population represented, which makes them cheaper to insure. And the third element is, from a consumer's perspective, it's often cover that you can get where you might not cover because it's not medically underwritten. So they don't generally question you about your health, and most will cover some pre-existing conditions. Sometimes there's a waiting period. So Australian Super, for example, has a 2-year waiting period, but many of them will cover pre-existing conditions. So if we get somebody who has a particular health condition that means they can't buy individual insurance, then default insurance is the way to go. So it's the insurer of last resort to some extent. The downside of it is that because it's a contract between the super fund and the insurer, is you don't get a lot of the protections that buying it direct from the insurance company gives you. So an insurance company, so the super fund will generally go out to tender every few years to try and keep the premium costs down. Their biggest incentive is to have a low premium rather than particularly good benefits, because most consumers are able to assess the price. Few have the skills to be able to assess the quality of the cover. And so the super funds will shop very much on price. And so when they go out to tender, the conditions of the renewal may very well be significantly different. And there was a case a few years ago where Rest Insurance changed their insurer, and if you weren't actually employed on the day of that changeover, then you were no longer covered. So there's that uncertainty about future cover. All of which says that you are better off, all other things being equal, with what's called a retail policy. That is, by you going direct to the insurance company, usually through an advisor, but by contracting directly with the insurance company, you have what's called guaranteed future insurability, which means once you're assessed, you are covered for life as long as you keep paying the premium. So they can't adversely change the terms of the policy, and they can't refuse to renew it because you move to a more dangerous job or your health deteriorates. And so that's a really valuable tool, so that you know that when you buy it and you're young and healthy, you guaranteed to have it until you retire, as long as you keep paying the premium. The price will go up as you get older, but they can't change your price because of what's happened to you. So the price for 40-year-olds generally will go up, but they can't pick on you specifically because you've changed jobs, your health has changed. So generally that means that a retail policy is a better policy, but you can still use your super to pay for it. And that's the bit where people get confused. So you've got your default stuff in your super fund, which is provided by the super fund through a contract with an insurer who you have no relationship with. Or you can take money out of your super and give it to an insurance company to buy a policy specifically for you. The proceeds will still go into your super fund, and then you can choose how to take it out when the event happens. The one form of insurance that you can't do that for is trauma or critical illness. That cannot be bought in your super fund and will usually be bought outside the super fund. There are a few quirks about the events that can be covered using a super policy. So for income protection, really good example is you can only insure for your what's known as your pre-disability income. So if your income varies, or you might have been on unpaid leave, or your commission might have been a bit low, or your bonus was a bit low just before you got ill, and so a inside super policy won't necessarily cover the full amount of your income. So most retail policies have an add-on that you buy in your own name. Usually it's a very small amount of money, and that covers those little extra bits. So really important for people who are on contracts, really important for people who earn variable income, whether that's commissions or bonuses or shift allowances, and are really important for people who might go on maternity leave or change jobs. So they're the two big differences. The next one is tax treatment. So your super fund will generally get a tax deduction for the premium, whereas you could only get a tax deduction in your own name for income protection. So that means that most people would buy Life and TPD inside their super fund, trauma outside their super fund, and then you could go either way on the income protection piece. The net effect is the same broadly, because you could, your super fund gets tax deduction, you could get a tax deduction, so you end up in broadly the same place. So Life and TPD generally inside super, trauma generally outside, well, always outside, and income protection can go either way. The other piece about your super fund, most super funds allow you to buy additional cover, which is underwritten, but it's still a group policy, so you'll need to apply for it. And those policies generally work out more expensive than buying it outside super. There are a couple of minor exceptions, and the minor exceptions are usually for people with heavy blue-collar jobs. So the default cover is rarely enough for anyone. They're usually a few $100,000 for Life and TPD. They're often unitized, which means that you buy X units of cover, and that level of cover usually declines with age. So they are rarely the right answer. They are the right answer for 25% of the population who can't buy insurance outside super, but they're usually very limited cover, generally not particularly good definitions. You've got the breakage of the link between you and the insurance company. You don't get guaranteed future insurability. So where you can, generally better looking outside if you need more than the default level of cover, which most people do. If you've got a particular health problem that means you can't buy it outside super, then or buy it in your own name, then you're limited to that default cover. So, yeah, it's like most things with personal finance. It's called personal finance for a reason. It's because it's personal. So the answer for everybody is different. But the way to do that is actually to go and get a quote, have a look through what's on offer, see whether you can get cover, and make the comparison. So they're the big differences with insurance between inside and outside super. It's about the terms and conditions, it's about the price, and it's about the ability to make sure that you've got that cover from when you buy it till when you stop needing it, which is probably the day you retire. Is that clear about the difference between inside and outside super? It can be a bit obscure, and the best thing is to have a look at your own needs. Generally, depending on what you do for a living, some occupations need more cover than others. If you're a surgeon, for example, or a medical profession, you might need to look at needle stick, which may not stop you working but could result in losing your license, or contracting Hep C, for example, might stop you practicing as a surgeon but wouldn't stop you doing other medical practitioners. Pilots, there are a lot of medical conditions that could make you lose your medical clearance to fly. Train drivers, if you get epilepsy as a train driver, you might be able to work as a guard or a station hand, but you're not going to be able to earn the same level of income. So all of those things go to why the package needs to be tailored for each one, and why this is generally not a product that you should try buying without assistance. The other big difference between super and non-super is the form of TPD available. There are two types. There's what's called any occupation, which is usually what you'll see offered unless you specify. So any occupation says that if you're unable to work and unlikely to ever work again in any occupation that you are reasonably qualified and experienced for. Now that doesn't mean that if you're a clerk in an office and you get RSI stops you using a keyboard, for example, you're not going to have to go and, well, just because you could flip burgers doesn't mean that's what you're going to have to do. It's about what does your resume look like? What have you done in the past? What are you educated for? And that's how it's assessed. So for most white-collar workers, if you can't do your own job, it's very highly unlikely that you could do other things. The alternative, a more expensive option, is called own occupation, and that looks specific at your own occupation. And that's important for people who get paid more than other people with similar qualifications. So surgeons are really good examples. So things that might stop you working as a surgeon, Parkinson's, Hep C, all those things might stop you practicing as a surgeon, but you could teach, you could work as a GP, you could do all those sort of things. So for those sort of pilots, people who work FIFO, all those sort of specialist skills are reasons why you might choose to pay the extra for own occupation. Very complex legal definitions there that really take an expert to work through, but it's really based on your occupation. It's about 40% more expensive than ENIOC. In super, you can only buy ENIOC, so an own-OC policy would be bought with an outside super add-on. So you'd pay for some of it outside your super, some of it inside your super. So lots of complex stuff. Yes, so any inside super policy, so a policy that is solely paid for inside your super since October 2021, will be an ENIOC policy. So it really comes down to what you do for a living. There's a very recent case with one of the big super funds, I think it was CBus, but don't quote me on that one. The guy was a long distance truck driver, so he used to drive trucks across the Nullarbor, and had a back problem, so he could no longer drive trucks across the Nullarbor. And he had been a taxi driver before he got his truck license. So CBUS said, well, actually, you could renew your taxi license and drive Uber, and he lost his case. If he'd had ONOC, that wouldn't have been a problem, or if he hadn't had previous experience driving a cab. So it's important when you're making this decision that you look at what your qualifications are, you look at what your experience and what your resume says. They're not going to go back and look at the fact that you flipped burgers at McDonald's when you were at high school. It's really a bad. So if you're a qualified physiotherapist and that's all you've ever done, then there's probably not a lot of difference between ONOC and INEOC. But if you're a long distance truck driver is a really good example. That pays a lot more than a delivery driver, so that might be a good case to look at ONOC. But inside super, it can only be INEOC since October 2021, and you'll need to buy an outside super add-on to get the ONOC. We find probably about 10% of the population makes sense to pay for the extra bit for ONOC, and they're generally those specialist occupations.